190, a fast-changing screen, at least on the index level.
As we speak, we've climbed above that 17,200 mark.
We are down 112 points, which basically translates to 0.6% cut. This comes after a near 4% cut in what is routinely described as the mother market, closer to the high like Friday as compared to the lower end. Banks and IT did well, IT more, and banks, of course, just about ending flat. Private banks doing particularly well.
Hello and welcome to CNBC TV 18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Sonal Bhutra. Here are the headlines for the day. Stock markets declined despite a late recovery. All sectoral indices end in the red, barring Nifty IT index. The rupee sees some volatile swings before ending the day flat. JLR reports weak sales for September on semiconductor shortage, even as demand for key models remains strong. Analysts see this delaying Tata Motors' deleveraging plans. The Enforcement Directorate moves the Supreme Court against Indiabulls Housing Finance, challenges a Delhi High Court order which had quashed a probe against the company over allegations of money laundering. Indiabulls Housing Finance shares slide in trade. JP Associates moves to cut its debt burden. The board approves the sale of cement assets, including a grinding unit in Madhya Pradesh worth around 5,000 crore rupees. Oil prices take a breather. Brent and NYMEX come off 5 weeks high as markets book profits on expectations of tighter supplies following OPEC plus cuts and ahead of the European Union embargo on Russian oil. Okay, here's the lineup of what we have in store for you. It's a packed show today. In Market Voices, we have Manish Sonthalia of Motilal Oswal AMC and Ken Peng of Citi Private Bank. And in Corporate Voices, we have Vivek Chand Sehgal, the chairman of Samvardhan Motherson International. But as always, let's start the show with the market action. Weakness across Asia and Europe rubbed off on Dalal Street as well, where shares largely came under pressure, but there was a recovery after a sharp fall at opening bell. In the end, Sensex and Nifty lost nearly 0.5%. All sectoral indices ended in the red, barring Nifty IT. Prashant Nair is here with the market wrap. Prashant.
Incredible outperformance once again displayed by markets here in the face of what was an absolutely brutal sell down in the US on Friday. The index ending, lower, but nothing compared to what we saw in global markets, really. Bulk of the outperformance came from two sectors: the Nifty IT index, and IT, of course, is the first off the block in terms of reporting results, and banks, private banks specifically, which did very, very well today. TCS, Infosys, Wipro were some of the top gainers. Midcap IT also started participating in the second half. Axis Bank was a standout gainer, 2% gains there, but there were others as well. HDFC Life, even a name like Maruti from the auto pack did quite okay. In the broader market, there was, of course, enough going on. Declines outnumbered advances naturally, but there was no panic in the market. Right from the word go, even when the market saw that big gap down, the question is what next? You would imagine that after facing off and coming out, on top from Friday's session, what we saw in terms of reaction today, the market will be able to face anything. And that is the mood out there that, despite all the troubles that the US is seeing because of tightening, financial conditions tightening, very big downsides may not be there. The joker in the pack really for India is oil prices and where they go from here. They're very close to getting to the 3-digit mark, and that needs to stay well behaved. The range for the market, I think today's low at about 17,050 is important, and on the upside is about 17,300, which pretty much was almost the day's high today. Back to you.
All right, Prashant, thanks a lot for making sense of the market moves today. We'll get you some expert opinion now for you. Manish Sonthalia, Head Equities PMS at Motilal Oswal AMC, gave us his outlook for Dalal Street and said that it is a buy on dips market. On the auto sector, he said that the biggest tailwind for the players is in terms of volumes. Listen in.
Key monitorable is earnings, and I think anywhere between 850 to 900 EPS on the Nifty. If that holds, I think it's a buy on dips market. No two ways about it. Because I think if you look at high frequency indicators, oil has been below 100 for the past 60 days. Inflation is flatlined for most regions of the world. Somewhere it is also declining. No major sector has seen a price increase over the last 40 days. India's PMI is at 55. GST collections at 1.4 lakh crores every month. Realistic assumptions and prognosis by the RBI of 6.7% inflation for India. All in all, I don't think, we have serious red flags as far as India is concerned. I think the biggest tailwind is happening in terms of volumes, and that after a very long time, because volumes are now picking up in a big way. There has been a pent-up demand, and that's getting fructified on the easing of supply-side challenges. Quarter on quarter, there has been a fall in raw material costs, primarily steel, aluminium, so it is aiding margins as well. So I think after a very long time, you will see Q2 numbers for automobile companies actually show some robust growth, more on for the OEMs as opposed to the ancillaries.
Okay, that is the opinion coming in from Motilal Oswal Financial Services. In more opinion, we spoke to Ken Peng, Asia Pacific investment strategist at Citi Private Bank. He said that India has outperformed in both the currency and equity markets. Added that probability of more tightening by the US Federal Reserve is stronger now than a week ago. Take a look.
India has outperformed both in terms of currency and equities by a large margin. And a lot of that, I think, has to do with beneficial inflows, right? Because if you have an EM mandate in India, it's kind of maybe to a lesser extent Indonesia as well. These are the only markets that are absorbing inflows, and I think that's been driving part of that. So the foreign inflows have been driving part of that outperformance. All these signs, like you mentioned about the jobs and the oil, that probably delays or slows down the roll-off in inflation. So support for more Fed hikes, for more Fed tightening is stronger now compared to, say, a week ago.
That is some market opinion coming in. Moving on to the second headline for today. Tata Motors fell over 4% after the company's JLR sales fell 5% in the second quarter. Sonia Shenoy is here with all those details. Sonia.
Thanks a lot for that. As you rightly pointed out, Tata Motors is the biggest Nifty loser today after the Q2 JLR sales failed to impress the street. In fact, the company said that it is because of supply side shortages, the semiconductor shortages, that the numbers were weak. But even if you look at the trend over the last many quarters, JLR managed to sell just 88,121 units, which is a fall of 4.9% year on year. But on an average, it would have done about 90,000 to 1.2 lakhs 3-4 quarters ago. So compared to its own average as well, the numbers have come down quite a bit. And this at a time when a lot of other automakers are seeing a revival in sales. So that's where the disappointment comes through. If you look at the breakup, Jaguar sales are actually down almost double digits, down 9.9% year on year. And Land Rover sales are down by about 3.6%. In fact, JP Morgan put out a note this morning where they downgraded Tata Motors from an overweight to a neutral. They say that because of the weakness in sales, it also delays the deleveraging timeline, and the company, may find it challenging to meet their own guidance that they had laid out of deleveraging. The miss, though, is driven by supply chain constraints. The wholesales have disappointed, while the retail sales are slightly better than what the street was estimating. Hence, the stock is under pressure. We had a chance to speak to a lot of auto ancillary players that supply to Jaguar Land Rover, like Motherson Sumi, for example, and they said that the China market is still under quite a bit of pressure because of the COVID challenges there, and that seems to be the problem pocket for Tata Motors. Back to you.
Okay, that is about Tata Motors, but Sonia, stay on. Atul Auto rally today after it announced a preferential issue of warrants worth 115 crore rupees. Take us through those details. What happened here?
This is very interesting because this is Vijay Kedia's re-entry into Atul Auto. It was his biggest success stock, multi-bagger stock way back in 2005. I'll tell you about that. But for now, here's the news. Veteran investor Vijay Kedia will invest in Atul Auto through a preferential issue of warrants. Now, the total warrants issued are to the tune of 115 crores, out of which Vijay Kedia will invest a little over 100 crores. A total 58 lakh warrants have been issued, out of which 50 lakhs will be issued to Vijay Kedia, and the shareholding of Vijay Kedia will increase to 18.2% post-conversion to equity. Now, why is he interested in this company? Let's not forget Atul Auto is a three-wheeler manufacturing companies. They are into passenger as well as commercial carriers, and basically they manufacture rickshaws. They are into e-rickshaws as well. And if you look at the sales performance, the last 2 years were a bit challenging for Atul Auto, but this fiscal things have improved quite a bit. So if you look at it year to date, April to September, the sales are up by 78.6% year on year. In September itself, the sales have gone up a little over 20% on a year-on-year basis. So the business is picking up. Now coming to the interesting part, Vijay Kedia, as we know, is a well-known value investor. He has over 30 years of experience in the stock market. Atul Auto was one of Vijay Kedia's biggest multi-baggers in the past. So way back in 2005, he invested in Atul Auto at a price of 9 rupees. The stock in the subsequent 9 years went up in excess of 5,000%. So that was the big multi-bagger idea. Of course, then the stock fell a lot from there, and now his reinvestment just tells you about the potential perhaps that he sees in the commercial vehicle business, the three-wheeler space picking up quite a bit. Back to you.
Okay, interesting analysis there. Sonia, thank you so much for all those details. Moving on to the third headline today, Indiabulls Housing Finance fell close to 6% after the Enforcement Directorate moved the Supreme Court, challenging the Delhi High Court's order to quash the probe against the firm. Ashmit Kumar is here with all those details. Ashmit?
Well, it was just this last month in September that the Delhi High Court had quashed the ECIR that served as the basis of the ED investigation into Indiabulls Housing Finance. What's important is that this ECIR also served as the basis for ED search and seizure operations, as well as various lookout circulars that had been issued against members of senior management of Indiabulls Housing Finance. Now, the Delhi High Court had held that the FIR that serves as the basis of this ECIR has been done away with, has been quashed, and therefore the ECIR cannot survive. The ED investigation cannot survive, and therefore needs to be quashed. The ED, we understand, has now challenged that order before the top court of the country. The ED has held that there are various PMLA violations which are blatant, which cannot be ignored, which need to be investigated, and therefore the Delhi High Court order needs to be vacated.
Okay, that's the update on Indiabulls Housing Finance. The stock was down 6% in trade today. Ashmit, thank you for those details. Meanwhile, Bandhan Bank was under pressure and fell 3% on back of its quarterly update, which showed a sharp drop in retail deposits. Abhishek Kothari is here with the details. Abhishek.
Well, to begin with, Bandhan Bank, nothing home to write about the loan movement that they have seen in H1, and they are also losing sheen on the retail deposits. So the book has remained flat for H1 FY23 when compared to FY22 numbers. Overall, the advances in Q2 FY23 have grown by 21.7% YOY and about 2.8% sequentially. There has not been significant improvement in collection efficiency, given the fact that collection efficiency was at 97% as of September, which compares to 99% that they had in the month of March. So CASA ratio has also declined. It is the low-cost deposit ratio declined by almost 240 basis points on a sequential basis, coming down to 40.8% when compared to 43.2% in the previous quarter. Even the retail deposit, they are losing sheen over there. It's declined by 520 basis points on a sequential basis to about 74.1% of the overall deposits when compared to 79.3% in the previous quarter. Back to you.
Okay, that is what Bandhan Bank, but Abhishek, Paytm gained over 3% in trade on the back of its second quarter business updates, a lot of it coming in. Tell us more about this and what happened here.
Well, the ticket sizes might have increased as per my calculation. So the number of loans disbursed, that's up about 223% on a YY basis and about 8.5% sequentially. The value of loans disbursed, that's up almost 32% on a sequential basis. So if you take into these two numbers and calculate, the average ticket size in terms of disbursals is up about 80% YOY and about 21.5% sequentially. The gross merchandise value, that's up more than 62% YOY and about 7.5% sequentially. The average MTU, that is, is at 8 crore, up 40.4% YOY and about 6.7% sequentially. If you calculate GMV per MTU, it comes to about 39,750 rupees, which is up 15.6% YOY and about 0.7% sequentially. So the disbursements are seeing an uptick in terms of ticket sizes for Paytm in Q2 FY23. Back to you.
Okay, that is all about the BFSI space. Moving on, the Union government invited expressions of interest for the privatization of IDBI Bank on Friday. The government plans to offload the 30% stake it owns, along with another 30% stake held by the LIC or Life Insurance Corporation. So in all, the winning bidder will get a little over 60% shareholding and management control of IDBI Bank. My colleague Sapna Das spoke to DIPAM Secretary Tuhin Kanta Pandey on the modalities of the exercise and the government's expectations. Listen in to what he had to say.
The government will keep a 15% residual equity, and LIC also will keep 19% residual equity for the time being. But this will be, subsequent to post this investment, it will be up to us to really decide as a time. There is a lock-in requirement of 40% for 5 years. That's a RBI requirement, so that the promoters which are identified, they are locked in for a certain period of, and they don't walk away. Going forward, it's important that, that the capital is further brought in for its growth, and it is put onto a further growth path, and then government and the LIC actually will exit, because in any case LIC was to exit, government was to exit. So this is not something which exit was not. The only thing is that, this decision has been taken to do it together in a strategic disinvestment manner.
All right, with that, we'll slip into a short break now, but stay tuned. We'll be back in a jiffy with the other headlines. Welcome back. You're still with us on Markets Today. Let's go to the rest of the headlines that we are tracking for you. To the fourth headline now, Jaiprakash Associates gained over 10% after the company's board approved the divestment of their cement business. Nimish Shah is here with all those details. Nimish?
So it's not only JP Associates but JP Power as well. Even both the boards today have approved selling their non-core assets. So for JP Associates, the board has approved to sell the majority of the cement assets. Now, if you look at the annual report, they have a installed capacity of 10.5 million ton, according to the latest annual report for JP Associates. So that's the first information. The second is even the JP Power board has approved selling the grinding unit. Now, what I understand from sources, a large conglomerate is going to buy the entire assets of the JPA group in today's deal. So that's the word from the sources. Now, if you look at the proceeds of this cement assets will largely be used to pay the debt, according to the press release as well. So if you look at the group debt for JP Associates, it's close to 28,000 crores, which includes both short-term as well as long-term debt, and majority of the money which they will receive from selling the cement assets will be used to pay the debt. Now, the most critical part for JP Associates is one, the shareholders won't benefit anything because most of the money from the asset sale will go to the lenders. But what is important is the SBI, which is a lead banker in JP Associates, they were almost pretty much close to dragging the company to NCLT. Now that the proceeds have come or will come, there is a very high likelihood that the lenders will not take JP Associates to NCLT. So that's a benefit as far as the JP Associates is concerned. For JP Power, it's a small grinding unit is what I understand, a small money that they will get by selling this particular asset. And again, that money will be used to pay the debt in JP Power Venture as well. So official announcement from both the group is they are looking to sell the large part of the cement assets as well as the non-core assets, and the proceeds will be largely been used to repay the debt.
Nimish, thank you so much for all those details. Well, TCS has kicked off the earnings season and came out with its second quarter numbers post-market hours. Reema Tendulkar is here with the highlights of those numbers. Reema?
Thanks so much for that. TCS Q2 surpassing expectations in both revenues, margins, constant currency revenue growth at 4%, EBIT margins at 24%, expanding by 90 basis points, again higher than street expectations. The company's won orders worth $8.1 billion in the quarter gone by, similar to what they had in the last quarter. So that's a positive, because the street was worried that with the challenging macros that we're currently in, the deal wins could show an impact. That's not been the case this time. In fact, the two troubled verticals, Europe as well as UK, have shown close to about a 15% year-on-year revenue growth. The only worrying point has been the hiring numbers. Hiring for TCS is sub 10,000. This is a big drop-off compared to the hiring numbers that they had in the prior quarters. Why is that? That's point number one. And secondly, attrition has gone up even further, 21.5%. But the management is fairly confident that attrition has peaked out. In a nutshell, TCS has delivered, and beaten street expectations on both revenues as well as margins. So at least for now, this should allay street concerns.
To the fifth headline today, global oil prices dipped on Monday after markets booked profits on expectations of tighter supplies following OPEC Plus cuts ahead of the European Union embargo on Russian oil as well. Manisha Gupta is here with the details. Manisha.
Well, the crude oil prices clearly seem to be consolidating after 15% of gains in the previous week, which, by the way, was the best weekly gain in 8 months. We've seen the crude oil prices come back all the way from $80 off a low to around $98 off a high. So that clearly has been nearly $18 off a jump up that we've seen in case of the crude oil prices. Markets are taking support from the OPEC and allies output cut of 2 million barrels per day. What the markets had factored in was 1 million barrel. It eventually would be that, but that really creates nearly 2.5 million barrels of a deficit in the international markets. That is where the crude prices are taking support from. Today hasn't been such a great day because you've seen the US dollar index gain up to 113. This is in reaction to the US non-farm payroll data that came in better than expectation, and that tells you we perhaps would be looking at aggressive rate hikes going forward. That is what is weighing onto the markets, but crude oil prices, even despite of that, have seen strength continuing for them. The markets also are looking at Russia, saying that if they do face price caps from US and other countries, they would stop selling crude oil and gas to those countries. So there could be some more supply concerns coming in from there. Apart from that, it is also about the US inflation data that the markets are waiting for. And this week, you have China inflation and China trade data as well coming in this week. So plenty of data, and yet another volatile week is what crude prices could be looking at.
Oh yes, absolutely. Manisha, thank you so much for joining us with those details. And with that, it's a wrap on this edition of Markets Today. Thank you for watching.